Will the housing market crash? Is it going to boom all over again? I mean, let's be real, it feels like every single headline is telling a completely different story, making it almost impossible to figure out what's really going on. But what if the answer isn't a crash or a boom? What if all the data is actually pointing to something else entirely? Okay, let's get into this because the expert forecasts for 2026 are painting a surprisingly clear picture.
This is the big question, isn't it? Whether you're trying to buy a house, sell your place, or just stay put and see what happens, you're wondering where this roller coaster is heading next. Everyone's looking for that one clear answer. And you know what? The predictions from the major housing experts are finally starting to line up around one central theme. And boom, here it is. This quote from Zillow really just hits the nail on the head. Forget the doomsday crash scenarios, and forget the explosive boom times. The key word for 2026 is stability. It's all about a market that's finally taking a deep breath after years of just complete chaos. To really wrap our heads around this shift, Redfin has coined a term that I think is just perfect: the Great Housing Reset. Now, this isn't about things snapping back to the way they were before. It's about finding a brand new and hopefully more sustainable balance. So, what on earth does this reset actually feel like? Well, think of it as a market that's finally maturing a bit. It's not that wild anything-goes frenzy we saw during the pandemic, but it's also not the catastrophe some people have been banking on. As one economist put it so well, it's an environment of progress, not perfection. I love that. Okay, so with this great housing reset as our backdrop, let's tackle the topic that is on absolutely everyone's mind: prices. What are they going to do? And maybe more importantly, can anyone actually afford to buy a house in this new world? There is so much anxiety out there right now, and for good reason. A lot of people feel like owning a home is more out of reach than it's ever been. But to really understand what's happening today, we got to take a quick step back and get a little historical perspective. Now this is fascinating. As an expert pointed out in a Real Wealth interview, today's pain comes from this brutal combination of sky-high home prices and mortgage rates in that 6 to 7% range. But back in the 1980s, well, home prices were way lower, but mortgage rates were, get this, an unbelievable 17% or more. So the point is, yes, today is incredibly tough, but it's a different kind of tough. It's less about the monthly payment being completely impossible and more about the insane challenge of just saving up for that massive down payment. And this number from Zillow, this pretty much tells the whole story of 2026. They're forecasting a pretty modest 1.2% growth in U.S. home values. So why isn't it a crash? Well, because inventory is still historically low. And why isn't it another boom? Because these higher mortgage rates are keeping demand from going crazy. It's not a crash. It's not an explosion. It's stabilization. Of course, home prices are only half the equation, right? The other huge piece of your monthly payment is that mortgage rate. So the big question is, where are interest rates actually going to land in 2026? So before we get to the prediction, it's super important to understand what actually moves these rates. It's not just one thing. First, you've got the Federal Reserve. Their decisions basically set the tone for all borrowing. Second, and this one's a biggie, is the constant dance between inflation and the 10-year Treasury yield. Just think of that Treasury yield as the benchmark for long-term loans. When it goes up, mortgage rates almost always follow. And third, the overall health of the economy, especially the job market, is what gives the Fed cover to either raise or cut rates. And wow, this timeline really puts it all into perspective. We just came out of a period of historically, freakishly low rates. Those sub 3% mortgages were a total anomaly, not the rule. That 6 to 8% range we saw in the 2000s, that's actually much, much closer to a historical norm. So with all that in mind, here it is. Redfin's prediction for the average 30-year fixed rate in 2026. They're expecting rates to settle in right around 6.3%. The consensus here is pretty clear. The days of those ultra-low rates are behind us. A rate starting with a 6 is the new normal we should all be planning for. Okay, so we've got stable prices, and we've got rates hanging out in the 6% range. But what about the other major complaint we hear all the time? There is literally nothing for sale. Is that finally going to change in 2026? To get why there's nothing for sale, you have to look at this number. According to JP Morgan, the U.S. has underbuilt by 3 to 4 million housing units since the Great Financial Crisis. That is a massive decade-long deficit, and it's the core reason why inventory feels so incredibly tight.
We just haven't built enough homes for the people who need them, and that's why you see so much competition for the few homes that do hit the market. Now, while the supply of existing homes is still really low, there is a bright spot, and economists are pointing right to the new home market. Builders are really working hard to sell their inventory, and they're often offering some powerful incentives, like mortgage rate buydowns, to get buyers off the sidelines. A buydown is basically when the builder pays a chunk of money to lower your interest rate for the first few years of your loan. We're talking hundreds of dollars a month in savings. For a lot of people, this might be the best shot they have at finding a home. All right, so we've been talking about the big national picture. But as we all know, all real estate is local. And in 2026, there are some pretty powerful wildcards creating huge differences from one part of the country to the next. One of those wildcards is the cost of, well, everything. JP Morgan makes a great point that as global trade patterns shift, it creates a higher floor for inflation. Now, that's not just some abstract economic idea. It directly hits your wallet. For instance, if it costs more to import lumber because of new trade routes, guess what? The price of that new construction home goes up. And this is where it gets really interesting. Redfin's forecasts show this clear divide happening. You've got markets in the Northeast and Midwest, places like Syracuse and Cleveland, that are expected to heat up. Meanwhile, areas like coastal Florida and parts of Texas are predicted to cool down. And that's partly because of things like surging insurance costs and companies changing their remote work policies. The takeaway here is crucial. Where you live matters more than ever before. Okay, we've covered prices, rates, inventory, and all the wild cards, so let's bring it all home. What does this whole great housing reset actually mean for you? Here's your playbook. For buyers, the message is loud and clear. You can breathe. The panic is over. You have more time to think because prices are finally stabilizing. But you've got to plan for that 6% mortgage rate because those 3% days are almost certainly gone for good. And don't get paralyzed trying to perfectly time the bottom of the market. A 1.2% increase is way more manageable than the crazy jumps we've been seeing. And like we said, pay very close attention to new construction. That's where you might find some of the best deals with those rate buydowns. Now for sellers, 2026 is shaping up to be a year of security. Demand is going to be way more predictable, which should protect all that equity you've worked so hard to gain. You're not going to see the absolute frenzy of 2021, but you're also not going to see a collapse. And here's a great tip from Zillow. When you're selling, focus on highlighting features that help buyers with their total cost to live. You know, things that save them money on utilities or insurance. That helps them justify the monthly payment in this new normal. So that's the picture for 2026. It's not a market of wild extremes, but one of slow, steady adjustment. A market defined by that idea of progress, not perfection. With stability finally returning, the question really isn't when is the market going to crash anymore. Instead, it's, in this new, more predictable reality, what's the right move for me?